Thanks very much for being here today. Pardon me. Over the past year, the economy has been growing at a strong pace. The unemployment rate has been near record lows, and inflation has been low and stable. All of those things remain true today. Since the September meeting of the FOMC, however, some cross-currents have emerged. I'll explain how my colleagues and I are incorporating those cross-currents into our judgments about the outlook and the appropriate course of policy. Since September, the U.S. economy has continued to perform well, roughly in line with our expectations. The economy has been adding jobs at a pace that will continue bringing the unemployment rate down over time. Wages have moved up for workers across a wide range of occupations, a welcome development. Inflation has remained low and stable and is ending the year a bit more subdued than most had expected. Although some American families and communities continue to struggle and some longer-term economic problems remain, the strong economy is benefiting many Americans. Despite this robust economic backdrop and our expectation for healthy growth, we have seen developments that may signal some softening relative to what we were expecting a few months ago. Growth in other economies around the world has moderated somewhat over the course of 2018, albeit to still solid levels. At the same time, financial market volatility has increased over the past couple of months, and overall financial conditions have tightened. That is, they have become less supportive of growth. In our view, these developments have not fundamentally altered the outlook. Most FOMC participants have instead modestly lowered their growth and inflation forecasts for next year. The projections of committee participants released today show growth continuing at healthy levels, the unemployment rate falling a bit further next year, and inflation remaining near 2%. The projections also show a modestly lower path for the federal funds rate, which should support the economy and keep us near our goals. As the economy struggled to recover from the financial crisis and the subsequent recession, the committee held our policy rate near zero for 7 years to give the economy the best chance to recover. And the economy did recover, steadily, if slowly at times. 3 years ago, the committee came to the view that the best way to achieve our mandate was to gradually move interest rates back to levels that are more normal in a healthy economy. Today, we raised our target range for the short-term interest rates by another 1/4 percentage point. As I've mentioned, most of my colleagues expect the economy to continue to perform well in the coming year. Many FOMC participants had expected that economic conditions would likely call for about 3 more rate increases in 2019. We have brought that down a bit and now think it is more likely that the economy will grow in a way that will call for 2 interest rate increases over the course of next year. We always emphasize that our policy decisions are not on a preset course and will change if incoming data materially change the outlook. And given recent developments, the statement notes that we will continue to monitor global economic and financial developments and assess their implications for the economic outlook. Now I will provide some additional context and detail, starting with a review of policy over the last year. Last December, the unemployment rate was 4.1%, and inflation had been running just below 2%. FOMC participants and many other forecasters were predicting that growth in 2018 would be strong. This growth was predicted to push the unemployment rate down to near historic lows, and the increasingly tight labor market was expected to help push inflation up to 2%. Given this outlook, committee members judged that the appropriate way to sustain the expansion with inflation near 2% was to continue gradually withdrawing the extraordinary support for the economy that had been in place for almost 10 years. Thus, in December 2017, the median of the projections of FOMC participants pointed to 3 1/4-point interest rate increases in 2018, which would have left the target range for the federal funds rate at year-end at 2 to 2.25%, still below most estimates of the longer-run normal rate. Early in 2018, it became clear that the economy was likely to be even stronger than we had expected, in part because the fiscal stimulus adopted near the start of the year was larger and more front-end loaded than most had anticipated. The signs of a more robust economy proved accurate, and the FOMC has now raised rates 4 times this year, counting today's action, one more time than anticipated in the median projection a year ago.